Hey guys, what's up? Welcome back to The Impeccable Investor. The Exchange Traded Fund, or ETF, is the talk of the town for getting money quick. People spend hours on analytics and online graphs to see which stock is doing well and which one to invest in, but today we will guide you to the best ETF stocks of 2020 that are doing pretty well and might turn over you a profit. Let's see what they are. SPDR S&P 500 ETF, ticker SPY. Simply elegant. This legendary fund is one of the better ETFs for 2020, as it is one of the fastest and most cost-effective ways to tap into U.S. capital. Benchmarked among the 500 biggest publicly listed U.S. firms that make up the S&P 500, this ETF rounds out big stars from all parts of the American economy, like software such as Apple, AAPL, banks such as JP Morgan Chase & Co., JPM, and healthcare businesses such as Johnson & Johnson, J&J. iShares Russell 1000 Growth ETF, IWF. When you like a bit more upside value with your investing plan, a simple approach is to tilt your investments against stocks that earn higher earnings and revenue than their competitors, rather than merely going with the crowd. Through having a sample of the 1,000 biggest U.S. companies and only reviewing the lower half using predictive measures such as calculating earnings growth levels, the IWF does this. Vanguard Value ETF, VTV. But, as described, what worked before might not function in the future. Even though growth stocks outperformed in early 2020, some buyers look toward value assets. As technological businesses seem a little overhated, some buyers look toward value assets as technological businesses seem a little overheated. Even economic volatility has settled in. Consider big credit rating stores. Plenty of money to back up their activities and long-term client relationships. VTV, though, is very distinct from the previous IWF development program. Schwab US Dividend Equity ETF, SCHD. With several investors pursuing secure return acquisitions, the logical next move is to pursue companies that are dedicated to long-term exchanging their consistent cash flow with investors. This is what the Schwab Mutual Fund offers, with an average return of around 3.5% across the portfolio of around 100 top U.S. companies. The fund is full of established brands, including chipmaker Texas Instruments, TXN, and shipping firm United Parcel Service, UPS. Yet SCHD selected these firms based on their dividend prospects and not just their scale. So buyers will tap into an above-average profit plan by betting on top businesses in America. iShares Edge MSCI Minimum Volatility USA ETF, USMV. While it may seem to be the most difficult fund on this chart, USMV is relatively clear as you take one move at a time. This ETF is benchmarked against a low-volatility U.S. equity MSCI index, ensuring it prefers stocks that can grow a little more while the economy is growing, but fall even less in periods of difficulty. This proposal applies to low-risk buyers in 2020 who might be worried about another major step like March's stock crash. Vanguard FTSE Developed Markets ETF, VIA. So far, it is based on U.S. equities. Yet, it is a large planet, and the fact is that many nations are now well past the pandemic's imminent economic effects, whilst the U.S. may struggle with outbreaks for the remainder of 2020. If you want to apply more geographical diversification to your portfolio, find this VEA investment, which only aims at big developed markets like Europe and Japan to create its portfolio. Vanguard FTSE Emerging Markets ETF, VWO. For more ambitious funds, this Vanguard sister fund provides an emphasis on developing markets like China, India, Brazil, Russia, and Mexico. These markets present a little more danger, particularly when it comes to virus-related economic impacts. Thanks to market and technological developments, they do have stronger long-term development prospects. You may already know the top holdings in this portfolio, including Asian tech titan Alibaba Group Holding, BABA, and Russian energy giant Gazprom, OGZPY. iShares Core US Aggregate Bond ETF, AGG. The ETFs on this page have so far protected securities. Nonetheless, bonds are an essential part of every portfolio, particularly for investors who are unsure about all-in stocks right now. This makes AGC one of 2020's best ETFs. A diversified debt portfolio encompasses all parts of the bond industry, including commercial and single-strip government bonds. The only condition is that bonds qualify for higher investment-grade rating, indicating low default risk. With rock-bottom rates, low-risk portfolio, and a large portfolio, AGC is a one-stop bond exposure store. iShares IBOX Investment Grade Corporate Bond ETF. This fund reduces government debt and concentrates on commercial investment-grade bonds. LQD omits low-risk, low-yield government defaults for high-quality corporate loans to Goldman Sachs, GS, CVS Healthcare, CVS, and AT&T. Despite the volatility to start the year, in 2020, certain creditors are already involved in safe haven portfolios. GLD provides this with an exchange-traded fund made solely of gold bullion, whose output is benchmarked to the precious metal. Investing in gold has drawbacks because this asset can be unpredictable and does not abide under the same laws as the capital market because it has no earnings or sales to think of. Nevertheless, gold is an inherently uncorrelated currency, ensuring it may trade independently from the equity market. Case in point. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.